Today we're going to talk about a little bit in the finance area of a thing called cryptocurrency. So we've got a great guest. Neither of us are fund managers or stockbrokers, and we've got a disclaimer coming up. But first, let's get to the show. So Sheldon, welcome to the show.
Thanks for having me, Bruce.
So let's talk first about your background. And while we talk about your background, we're going to put up this disclaimer that this is for informational purposes and does not constitute an offer, solicitation, recommendations. Hit pause on your screen to read the rest. Thank you. So what is your background and how did you first get introduced to cryptocurrency? Was it through Bitcoin?
Yes, I read the Bitcoin white paper in 2010. I graduated high school in 2008, so I'm dating myself. I'm a bit young, but entering the job market during that period of recession made me ask a lot of questions. And one of them was, why is the monetary system in the US structured this way? And ever since reading the Bitcoin white paper, I thought, wow, this is really cool. This could be a really great thing for the world. And then I put it down for a few years thinking, okay, well, this probably isn't going to happen. There's lots of great things that people try that don't really come to fruition. And before I knew it, I was doing firewall management at HP. I moved on to Arrow. ECS was the division I was under, but Arrow is a relatively large multinational company. I went back to HP for another short engagement, and then I moved into a sales position at the beginning of COVID, and that didn't exactly work out. There was one in between that I'm leaving out, but we could talk about that another time.
Yeah, because this is kind of what it looks like. Let me pull this up. What it takes to actually mine coin, and we're not going to get into mining coins at all on this show because it's a little bit beyond anybody's realm. But
and the thing to note in the context of that statement is the age. It's 2014. So in 2014, the sort of corporate scale mining that you're looking at right there with application-specific integrated circuits, or ASICs, was much smaller and much less common. CPU mining was a very regular, everyday thing. So people were just using regular computers to mine crypto, and sometimes that had some negative effects.
And so this is kind of a talk about IT security, about preventing people from getting in to attack for any reason, either through some sort of, I don't know, phishing campaign, just so they have access to your computer, and then you use it as a background, kind of like file sharing.
Yeah, any method where you can, exchange data with somebody else, there's the propensity to sort of misuse it, whether it's links or dropping binaries in the background. There's usually opportunity. That's part of the reason why I'm still in InfoSec and cybersecurity, because I see that there's going to be, demand and need for that for an extended period of time. It's a very large ocean to boil, but we're always trying to boil it.
As far as fluctuations in the market, how does crypto fluctuate?
There's a lot of fundamental factors. There's a lot of people in crypto who live and die by TA, or technical analysis, i.e. charts. I don't do charting because I'm not a trader, but from a fundamental analysis perspective, in the short term, it's easy to look at two things. One, there's a list of option calls, futures of people saying the price will be X that end at the end of the month, and I believe that's actually the last Friday in the month, so that's tomorrow instead of last day in the month. So there's that sort of candle closing, if you will, and that's an important moment on the monthly, because normally March is a very red month for Bitcoin, and it's been pretty nice and sideways this month. Also, with the end of Q2, organizations are going to be required to disclose their financials. So organizations that have been quietly buying Bitcoin in the background might have to be a little bit more forward about it in the next week, 2 weeks. That's a good short-term driver of fundamentals that you could say, hey, people are going to have to be talking about this in a different way in a short period. But at the same time, in a larger scope, in a larger zone of time and assets, not just Bitcoin, I usually describe the market to people as an amoeba. So it's not necessarily Bitcoin and all the rest, but it's Bitcoin and maybe two others at a time, sort of the dominating largest assets. They fluctuate, and then the others will fluctuate against them. So I call this kind of an amoeba effect, or amoeba market, if you will.
Okay.
That there's always going to be one leg kind of pulling the rest of the market in a direction, whether that's down or up. And usually that's kind of Bitcoin leading the charge, and you'll hear people say like, rising tide lifts all boats, that sort of thing. So.
And so it has no connection with the real world money market or the real world financial stock market. Is that what you're saying?
It's almost completely decoupled. There's some very small relative points that are worth noting. DXY, so the dollar index is one. The other is just the stock market, that there is a stock to flow model because of the amount of venture capital that's in crypto today. It's reasonable to look at that because of the way Bitcoin is structured, that um, the the inflation model that it depends on relies on the stock market being manipulated by things like the Dodd-Frank Act, which means the government can secretly inject money into corporations that need it. And I'm not saying this with a tinfoil hat on. I'm saying that this is a real regulation that was established after the 2009 recession. There's been applications submitted in that for the U.S. for many years, and they've been continually turned down. I think it's only a matter of time before they get accepted. I definitely support, interacting with traditional markets. I traded stocks long before I traded crypto. I wanted to have a lower risk portfolio sort of set up and put aside before I got into a higher risk space like cryptocurrency. And yeah, I definitely support that principle. And there's lots of people doing interesting things with digital assets that are in the traditional financial space. You don't have to get into this, manage your own keys and wallet addresses. You don't have to get into all that stuff if you're interested in digital assets, but you want to stay a little bit more reserved.
Yep. And also, it's better to diversify. I think there's a quote by Carnegie that says, "Don't or put all you can put all your eggs in one basket as long as you keep your eye on that basket." So if you're, and again, diversity is probably best. And in most cases, in this case, since it is somewhat speculative, it should probably be in a small portion. And who actually, in your experience, who is investing in crypto these days? Is it mostly the millennials, or are there some Gen Xers and um, baby boomers?
I would say that I see a pretty good volume of Gen X in the space. Not as large on the boomer side, but there are quite a bit of millennials and Gen Z that are participating. I think that there's two sort of inarguable points for that. One being that young people usually feel like they have, less to lose or more to risk. Hey, I can lose my entire portfolio right now, and then I'll just start saving again when I'm in my 30s or something. That's not
Mhm.
my position. I'm very unfriendly to risk in that way, but that's not most young people. So I think that the average young person has experienced 2008, 2009, has been in some way, affected by COVID, whether it's their parents losing their work, their neighborhoods and communities changing, or them actually losing jobs themselves. A lot of the younger kids had retail jobs when COVID hit. So I think there's a pretty good appetite for risk, but also there's a there's a more renegade attitude in there of not wanting to participate in the system of the U.S. dollar. You know, anyone who grew up sort of watching the U.S. government unfold after 9/11, excuse me, I think there's a pretty good case for them to say, hey, I don't feel comfortable with X, Y, and Z because of these things that I've seen from the government. I don't mean to get political, but people take it in different directions, and I think that's perfectly fine. But there is a reasonable ideology of distrust for, um, let's say legacy authorities or central authorities,
Mhm.
and a lot of it breaks out in the cryptocurrency space where people feel like they're, sort of participating in a different type of world where I usually sort of caution them and say, hey, pump the brakes. Decentralization is great, but it doesn't yank power completely away from any power structure today. It kind of just forces that power to be, more distributed and not just in the hands of a handful of rich people. So
As far
I
as
think that ideology attracts a lot of people.
Yep. As far as crypto goes, it's actually a currency, which means you can buy things with it. And that it's not just purely a hold or buy and hold, which may be one of the reasons why the price keeps going up is people buy and hold in anticipation of it going higher. But so if someone decides they want to go to some store and buy something. I think there was like a Home Goods or something like that, or Home Depot accepted Bitcoin, and someone goes in there and buys some sheets today, and they spend like what, zero point 0.5 Bitcoin on some sheets, really expensive sheets.
Wow.
So, or 0.001 on sheets. And then next week they go back to return those sheets and they want the exact number of Bitcoin back. That's not going to happen because I guess his owner says that he's not going to let his sheets be a hedge against the Bitcoin.
I think it's perfectly reasonable in a transaction like that where, people might argue store of value versus currency. This is one of the reasons why. But if Home Depot was saying, okay, we're going to not refund you the transaction fee that you paid to send us this value, charge you a 15% restocking fee because clearly those sheets are very expensive. And then further, there's a transaction fee for us sending the Bitcoin back to you. You're responsible for that as well. I think that's an unfortunate paradigm, but it makes complete sense. And you're going to see that more often, people questioning, hey, do we actually want to integrate this at a retail level? I do think there's lots of cryptocurrency and digital asset products that are great for transacting in that way. But as Bitcoin changes over time, it's going to establish itself less as a currency and more as a kind of gold, as Powell recently said. Um, there's a couple reasons why you wouldn't want to use it so transactionally, but to those who do, I definitely support it. It's just you have to be ready for those cost caveats that I mentioned earlier. Transaction fees in both directions, and then potentially a processing fee from the from the purchaser side, I guess you could call it, because they're the ones responsible for the asset in the meanwhile.
So here's another disclaimer. This is my nephew, um, who is a millennial. So his question is, do you think Bitcoin will ever be more useful tool for transferring value than fiat currency? If Bitcoin never becomes more useful than transferring value, then how do you determine its intrinsic value?
To be clear, I don't think that Bitcoin needs to replace fiat currency. I think that it's perfectly logical that we would have an internet of money kind of posture in the next few years. And this is already more normal to other countries like in the EU where they, accept EUR, but might also have Kronen or um, some other currency that they take. They're more used to exchanging frequently. Some vendors accept some things, some vendors don't.
There are other cryptocurrencies other than Bitcoin. Second in line is Ethereum, and then there's another like what BitLite or was it Litecoin?
Litecoin. Mhm.
And so there are other options. It's basically like, are you trading gold? Are you trading silver? Are you trading platinum? Or are you trading stocks? There are other options out there that you don't have to invest into a single coin, although Bitcoin seems to be the gold standard, the first viable crypto.
Yeah, Bitcoin is the oldest cryptocurrency and the oldest public blockchain of its kind. It's about 11 years old. Litecoin comes next at 9 years old. It is a Bitcoin fork. Um, but there's definitely a correlation you could make. A lot of people in the space have recently been comparing Ethereum to petrol, to oil, because Ethereum is more about what you can do with it than what the price of it is at the moment. Um, Litecoin, I do like making the argument of, silver to gold, as Litecoin is sort of Bitcoin's gold. Disclaimer, I'm very interested in Litecoin. I like using it. I like operating on it. I admin a Facebook group of 55,000 people about it. I I think that it's reasonable to look at the space when you're trying to get your bearings, especially if you come from stocks, to say, okay, how can I compare this? How can I get a better, sort of macro understanding of these products or these concepts? And um, Litecoin being the silver to Bitcoin's gold, there's different, more detailed things about the development and the technology, the signatures. But at a very base level, Litecoin is the second oldest blockchain product, and it is designed to be extremely efficient. The fees were reduced by 90% in late 2019. The transactions are extremely cheap, and people don't know that Litecoin actually has smart contracts. So one of my apps that I like to use that I'm, again, this is not financial advice. I'm not recommending this platform specifically, though I am friendly with the CEO. Bill's really excellent. But the point is, sorry, um, Abra, when it initially launched, used a system that I called Litecoin Cloud. Basically, it was using Litecoin smart contracts interacting with each other to manage other cryptocurrencies. So the idea is relatively simple. When you have other cryptocurrency wallets, they don't have to be stored locally on your phone as an app. You could just have the data needed to operate those wallets stored somewhere else. And Litecoin is a very cheap and efficient way to store those private keys, to store that information that you need, and then just pull it down with your own private key whenever you open the app.
So I got a question. We were talking a little bit earlier about IT security. Let's define how you actually keep your crypto available to you. There are a number of different ways. How would you describe those?
So the most important thing is hand over fist to have a wallet strategy. A lot of people, especially where I spend time these days on Clubhouse, are very excited about hardware wallets and multi-signature applications where you need like 3 different keys out of the total of 5 to move your Bitcoin. There's a lot of different things you can do that are high-level security at the point of the wallet. My personal position is a little bit in the other direction. I like to coach people on digital hygiene. I think that if you're going to have sovereign and digital control of your assets, that means that you need to recognize that you've, now become more valuable as a digital entity online. If your email has the power to reset a password for a platform where you have $10,000 sort of virtually stored, then suddenly that email is kind of worth 10 G's. It's it's a risk paradigm to say, okay, I do want to have custody of my own assets. I don't want somebody else to custody those assets, but then I'm responsible for my own personal security because I'm my own bank at this point. So I think that the strategy is the number one thing. Um, I I am using more than 20 wallet products. I experiment with a lot. I don't like having all of my money in one place in the event something went wrong. But I think the most important thing is a strategy, and most people are going to build that in the context of a hot wallet where they do most of their transactions. Um, a sort of warm or a medium wallet where they would have, stuff that they would touch once a month, once every few months, and then a cold storage mechanism of some type where you pretty much only send money into it and never pull money out of it, or never as best you can, right? So there's a lot of interesting things you can do, and hardware wallets are certainly increasing in popularity, but I don't recommend them to people because the space is very young. And I do know a few device security engineers that, will actively tell you, hey, there's 4 little, pins on this board. If you can solder to these 4 little points on this board, then you've got a decent chance to, see somebody passing their password in clear text. And technical nonsense like that someone could basically break into your um, cold wallet. As a concept, it's sorry, hardware wallet, not cold wallet. As a concept, it's pretty reasonable to say that um, the the strength of that cold wallet, the strength of that security is only as valuable as the dependencies around it, right? So if you are putting all of your money onto this little ledger or Trezor, this little physical device, and you carry that around with you in your pocket constantly, you're just moving that risk and threat surface to your physical person. I'm
Hmm.
not saying people are going to get kidnapped with their crypto, though it's not unheard of, but a lot of people don't realize what they're getting into when they move all of their digital assets into that physical form, because they're not acknowledging where the sort of security caveats come in. For instance, I believe it's the Ledger Nano X that has a Bluetooth module on it. So that wireless interface is now a threat surface. Bluetooth is a relatively easy technology to hack. There's a bunch of unpatched vulnerabilities out there. So, it's a different type of risk engagement where you're saying, okay, well, I want to move to a hardware wallet because I was told that's secure. Okay, but how are you applying that security is really the question. So I would say that the most important thing in having a cohesive and sensible wallet strategy is, keep it simple enough for you, but obfuscated enough so that if someone else, say, took over your email, that they would struggle to figure things out. And a lot of people in the past have lost their money overcomplicating things. So it's important to note that security is easy to sort of bury yourself under. And if you manage risk in a compartmentalized way, it's a lot easier than just saying, okay, well, this is my bag of crypto. I'm just going to cling to it, and I'll
Hmm.
feel safe because I have a hardware wallet. That's not always the most reasonable practice, if you ask me.
Tim wants to know how we can get in touch with you. Is there an email, or do you want, or can you reach out to you through Instagram? or what's the best way to contact you?
I'm a relatively public person on the internet. My name is Sheldon Deer, Dearr. You can find me on LinkedIn, Instagram, Facebook. I'm on Clubhouse pretty frequently, but um, I don't mean to give out my personal information. But if you search my first and last name, first of all, you find a bunch of hilarious pictures for me as a teenager. But it's pretty easy to find my LinkedIn. And if we haven't met before and if we haven't engaged in a social platform, that's usually my default, just to be professional.
As we mentioned before, there are funds that you can buy into, some companies that you can buy into that are investing in crypto in some way. So those are ways you can actually invest in this. Again, talk to your professional advisor for anything before investing. And diversify is another key word.
Absolutely agree. I made sure to have my low risk investments and my stocks as I wanted to feel comfortable with them long term before I moved into crypto. And I do recommend that very, very consistently for young people that like, hey, build your low risk positions first. Don't jump into the high risk stuff because you want to make money. Do some risk modeling. Is your risk tolerance such that you can be very comfortable sleeping at night losing $10,000? Okay, well, congratulations. You must be doing fairly well. But I think that's not the case for most younger folk, and they don't really feel the need to pivot to that sort of risk assessment, risk modeling considerations until they take it on the chin at least once. That's what I've observed.
And then there are other platforms like Acorn, where you can put in $10 a week into a stock or into a fund there, and you're buying micro portions of stocks and building your portfolio there.
Yeah, I was an avid user of Acorns. I retired from using the platform to focus more on other investments, but I sent them a message basically, hey, I'm leaving the platform because cryptocurrency and digital assets are not an option here. Still love your product, still recommend people to you guys, but I want to focus more on digital assets. So Acorns is definitely a good product for that. There are alternatives that you could schedule purchases on different platforms like Swan Bitcoin or Cash App to say, okay, I want to spend $10 a month to make sure I'm consistently accumulating a digital asset. And I do that. I do recommend that. But again, don't invest what you're not willing to lose. That's just, that's basics. I'm sure you're more than familiar.
Yep, definitely. Thank you. You've been wonderful. Hope to have you on again with a more in-depth conversation. Here's another express disclaimer that anything we talked about is not an endorsement of any product or service that we talked about. And hit pause to read this fully. And you've been a great guest. And talk to you soon.
Thanks so much for having me, Bruce. It's been excellent. Talk soon.
Thanks.